Oh, to look back at the 20th century, it was so easy. Investors needed only to save a few bucks, put it into the broad market through an index fund, and just wait for it to rise. Yep, there were bumps in the road, all right. Times when you would have wished you were out and held cash, but over the long term, it all worked out okay. Oh, for the old days. But now, we enter a brave new world in the 21st century where two dramatic forces are shaping to bring much more complexity to the world of investors: technology and globalization. These two interlinked forces are joining together to make the value proposition a worldwide investor dilemma with changes to the way we interrelate and work and the ways we earn return on capital. No longer can we just sit back and wait for the S&P to rise. Now we need to understand the DAX, the Nikkei, the Shanghai stock market, and we need to understand volatility. As the world grows to this transition to the next phase of its history, volatility will play an important part in the overall investment returns, and that is why today we're talking about tactical asset management. The old days of buy it, hold it, and close your eyes, or what was sometimes called a set it and forget it strategy, are gone. Today, investors need to be sensitive to global events in addition to company events, valuations, and new market opportunities that span the globe. And with that comes a need to understand that protecting your wealth will sometimes lead you to a strategy designed not so much to make money always, but oftentimes not to lose what you save. There is a statistic you should know about. If I start with $1, a single dollar, and I lose 10%, so my dollar is now worth 90 cents. How much do I have to earn just to get back to my original dollar? Well, the answer isn't 10%. I don't need to earn 10% to get back. I need to earn a little over 11%. Now, as you lose more, that number expands. If you lose 20% down to 80 cents, you now need to grow by 25%, not 20%, to get back to scratch. You get the point. More than ever, you need to consider your investment strategy as a dynamic strategy that can utilize the many tools available to put risk controls on your portfolio. This may be as simple as determining when to get out, not market timing, not using a crystal ball, but using a real common sense method to get out. You may choose to use the options market to hedge your bets. You choose the best tool, but the outcome will be the same. You've protected yourself from the problem that will arise as volatility gains a foothold in global markets. Now, a counter-argument can be made that we aren't in a long-term trend toward volatility, that the growth around the globe and bringing more impoverished parts of the world up to the middle-class standards will lead to global expansion, much like the U.S. boom from 1850 to 1950. That may be true, and to the extent you're invested globally, you may indeed see that growth. Well done. However, as this happens in the near term, volatility will still reign king because of geopolitical events and hotspots like Greece, France, the Ukraine, ISIS, Taiwan, India, Pakistan, and that list goes on and on. So yes, it is conceivable, and I would even say likely, that the global economy will grow nicely over the next decades. However, don't think that's going to be a straight line without bumps in the road. As globalization takes hold, volatility will come in, and from that, you need to be protected. So throw out the old, ring in the new, and realize that the easy days of the 20th century have been left far behind, and you and I now enter the brave new world of the 21st century.